invite our second market master for the day, Sridhar Sivaram, founder Siva Capital Advisors. He's a familiar face actually. When the camera pans, you will note he used to come once in a way when he was heading the fund management at Morgan Stanley. Sridhar, good morning. Thank you very much for joining us. Well, first up, this is something I want to ask you because you must have come into contact with a lot of FIIs in your previous avatar not so long ago, a couple of weeks ago. The government's decision to impose MAT on money earnings that the FIIs got in the last few years.
Correct.
Prospectively, they don't have to pay from this year onwards. Is that a worry at all? I mean, we are seeing minor FII participation, not a great deal. Is this a worry?
I think it's a big worry. Markets not yet understood the gravity of the problem. And what is even more worrying is statements coming from the Finance Ministry, the Revenue Secretary, talking about how legitimate this is. And the background of the whole thing is an advance ruling, which actually is from Glaxo Pharmaceuticals, who wanted to transfer their shares from Mauritius to Singapore. It has nothing to do with an FII. And it's a reasonably established principle that advance rulings are normally applicable only to the assessee who applies for the advance ruling. And there are similar advance rulings which have stated that MAT is not applicable. So there are multiple advance rulings. For some reason, the income tax and also the government is convinced that this is the right way to do. At a time when the PM is going around the world saying, I want certainty in taxation, here is one more googly where suddenly you come up with a statement that, you know, FIIs are not paying tax. This is not a safe haven. And I think one point is missed that, you know, the securities transaction tax, when it was initiated, this was in lieu of long-term capital gains tax. So actually FIIs are paying tax. So general view is FIIs are not paying tax. So because of securities transaction tax, even funds which are coming through a double taxation treaty are ending up paying the tax. So actually the government collects much more tax now than it was before when you had only capital gains tax.
Okay.
And I think this is very sad that instead of giving certainty of taxation, you suddenly gone into entire loop of taxing FIIs for the previous few years, whereas it was broadly established that FIIs will be taxed as long-term or short-term, and MAT was not applicable.
But do you see this hamper of future investments and sentiment by FIIs? Because you were just speaking with Jonathan Garner, and he indicated that yes, there is a bit of a worry, but it will not impact the flows, the FII flows too much.
I mean, prospective flows, do you think will be impacted? Because if prospectively there is a very clear understanding that you don't have to pay the money.
So actually this can have a serious impact on the P-note product itself. Now all participatory notes come through a tax haven. I'm using the word tax haven because they come through countries like Mauritius or Singapore. If these participatory notes are sent tax notices for the past year, somebody has to pay the tax. The way the participatory note is structured, you just can't pay tax because many of these funds have either redeemed or have gone. Also, taxation in India is first in, first out. Whereas the participatory note product creates silos for each client based on how they purchase and sell. So it is highly possible that there could be taxation for a certain transaction because of first in, first out, the way taxation is calculated in India. Whereas the client could have made a loss based on the way he's purchased. So who bears the tax? I think this is a serious thing. The entire concept of participatory note, which I think is 60% of the market, that product dies. Okay. So how do they fund this? So they'll have to obviously sell it.
Okay.
So I think this is very serious. The government's not understanding the gravity of this problem. It is not as simple as saying, hey, the FIIs will pay 40,000 crores. 40,000 crores to start with is a huge amount. Who pays this?
Okay.
I think this is very serious, and I think somebody needs to sit with the government to make them understand that, you know, there's daily NAVs for people and investors come and go. You need certainty of taxation. If there was a requirement for MAT, it should have been told upfront then, not after 3 years, and you're now opening, you know, past records.
Fair point. I guess the last word on this has not been spoken, and maybe the government will wake up to it. In any case, at the moment, we have not seen any FIIs selling at this point in time, so perhaps there is a hope that things will be sorted out. Okay, Sridhar, now let's come to the earnings season itself. We have seen 9,000 tending to be a bit of a roof. Do you think that in this earnings season we may not be able to cross it? We are not a great distance away. It's just about 200 points to reach out and cross the all-time highs, or maybe 300 points. But will that be possible at all this earnings season, or will it be the other way around, that you reach out to 8-2?
I'll be happier if we reach downwards, because the earnings season was going to be great. It's well documented, well written. We've seen some of the indicative numbers, be it auto numbers or any of the other numbers, cement numbers. Earnings numbers are not going to be great. So if the market continues to move up, it will find itself very difficult to sustain there, because there's no earnings support. And it isn't seeming as if the economy is also recovering. We see the credit growth numbers. It doesn't seem as if we are actually getting into a recovery mode. It's very slow. There are just initial signs of recovery. So I don't think the earnings season is going to be that great. So if the market doesn't move up, go past 9,000, I think that will be great for the long-term sustainability of this market. If it just stays here or even comes down by 5%, I think that will be the best option for the market.
Okay. How are you reading all that's being done by the new government, whether it's, just small, larger economic things like curbing of black money, the subsidy scheme, the coal auctions? There are things being done on the ground. How much of a positive do you think that is, and what more is the market looking for?
So I think what the government is doing is very positive, at least on the ground. When we speak to companies, I think the indication that we are getting is they're doing the right things. But if you see, many of these will take some time for it to actually reflect either in the macroeconomic numbers or micro on the company numbers, be it the coal auction, be it say any of the stalled projects which have been now given approvals. Actually, on the contrary, if you see the coal auction, you had the coal secretary talking about 3 lakh crores is the benefit that the states will get. Who pays the 3 lakh crores? It has to be paid by the companies, which one argues that you have to pay over, say, 20 years or 30 years. It still means a lot. You're talking of 10-20,000 crores per year additional payment by corporate India to the government, which basically means additional debt. So, yeah, same with the spectrum auction.
Sridhar, what would you do with the banks now? Because there is this expectation that earnings season will be weak for PSU banks, but there has still been some contrarian buying into this space.
Yeah, so if one were to take a view, slightly medium-term view, that the recovery will be underway, maybe 6 months, 12 months, and if interest rates will continue to fall, at least the macro numbers suggest that it should fall. I know that Raghuram Rajan has very different views, or he's been much slower than at least what I think he should be doing. I know there are different views on this. So banks do look like a good space to be in, but there could be some volatility, because we could see some more NPA shocks as we get into this earnings season. So one has to be selective. I think the private sector banks look much better positioned than public sector banks at this stage. And I guess over a 18 months period, maybe the public sector banks would also start to perform once the bad news is priced in.
Okay. What's the take on NBFCs? Is the rate trade over, or is there a big rate trade to play according to what you're saying?
No, I think the rate trade is very much there to play. Okay.
So NBFCs would be the way to play them?
NBFCs are a good way to play, because they have, many of the NBFCs are very specialized. So one has to pick and choose which NBFC you want to play. And it's, if the economy recovers, they would, those particular pockets would tend to recover faster, be it like a Shriram Transport or even some of the gold finance companies. Depends on how the economy is recovering, the demand for credit. So NBFCs do offer a very good space to look at.
Okay. I would assume Siva Capital will be advising a lot of high net worth individuals on how they should structure their incremental share exposure. How would you advise them for the next 1 year? Would you ask people to put incremental money in defensives like IT and pharma? Would you ask them to put it in private sector banks, financials, because the rate trade is very much there, as you say? What is the mix of sectors?
So actually in the short term, the market's looking fully priced.
Okay.
So the opportunity so if you ask me that if I have to put incremental money, would I be putting incremental money in the equity markets? The answer is no.
Okay.
At least in the short term. If I were to take a 18-month view, then possibly yes. Even then, I would say that we would get some sort of a correction. Like my personal view is this tax thing is huge. We are, it's like a sword hanging. We could see a market correction anytime. If that is the view, then you shouldn't be investing in equity right now, or at least I won't be advising that.
Tactically, no.
Tactically, no, because this is a sword hanging and doesn't seem like the government is really understood the gravity of this problem. But if I remove all this noise from there, even then earning support is very poor. So in the short term, no, debt opportunities are looking better if interest rates were to continue to fall. We saw the inflation numbers yesterday. They continue to be extremely good. So obviously the view is that interest rates would fall, so you're better off in a debt product in the very short to medium term. And if the market corrects, you look for opportunities to enter the market. That's how it will play.
All right. We'll leave it at that. Pleasure speaking with you, Sridhar Sivaram, and hope to see you oftener in the CNBC studio.
Thank you.